Hey everyone, welcome back to Chipstock Investor. It's Nick and Kasey.
Hey, everybody.
In this video, we will give you a brief update on ServiceNow after its latest earnings report.
Yeah, this is one that we have covered now for a number of years, and we finally started adding to it, including during the market downturn in March and April earlier this year.
To begin, let's show you this chart from our friends over at Fiscal.ai and the sponsor of today's video. This chart we're going to come back to later in the video, but to start with, let's compare GAAP earnings per share and free cash flow per share.
If you're trying to figure out and visualize the discrepancies, especially in software companies that you'll see between their reported GAAP earnings per share and free cash flow per share that we like to calculate and use in our analysis here at Chipstock Investor, Fiscal.ai is a great platform to do just that. Especially for a software-based business, free cash flow on a per-share basis is a great way to account for dilutive effects like stock-based compensation paid to employees.
If you want to dive deep into a business, a great way to do so is signing up for a Fiscal.ai membership and making cool charts like this one. You can get 15% off any paid plan with the link in our video description or right here on the page, fiscal.ai/CSI.
The stock price is back up over $1,000 a share. And let's see how they did in Q2, and we'll update market expectations based on the stock price. Let's look at the high level stuff here.
Subscription revenues, just over $3 billion, up 22.5% year over year. Current remaining performance obligations or RPOs, nearly $11 billion. And then the remaining RPOs, $24 billion. Cash flow margin, 16.5%, operating margin, 29.5%.
And there was currency exchange rate tailwinds here. So as we've been talking about, the decline in the US dollar is a benefit for US based companies. And so ServiceNow definitely got a bit of a bump from that in the quarter. Guidance, what's going on here? It looks like another little bit of a tailwind from currency exchange rates in Q3. And for the rest of the year, ServiceNow still looking at, just on the subscription revenue part of the business, upwards of 20% growth for the full year. There is going to be a bit of a headwind in Q3. They said a lot of customer contracts, an increased number of customer contracts are expiring in Q3 and Q4. And so there will be a little bit of a dip in the RPO as a result in Q3 as they negotiate new contracts with those customers. But they seemed confident that things are still going well. Also a bit of turbulence in US government contracts, also to be expected. But overall, a very positive report, very positive outlook. And of course, the big part of the story is ongoing continuous increases to that free cash flow margin, which is continuing to shape up very nicely for ServiceNow.
So let's look at a reverse DCF.
Subscription revenue plus other revenue, let's call it $13 billion expected for the year at a 32% free cash flow margin. If you want to use the full year expected free cash flow. So like $4.1 billion for 2025 divided by that 210 million share count. That's roughly how you can arrive at this. We use the 12-month figure for this one, but you could also use expected 2025 as well.
Gets you to free cash flow per share of $18.49, implies 18% free cash flow per share growth over the next 5 years, 7% terminal growth rate thereafter, and a 10% discount rate gets us to $1,050 per share.
Which is close to where it was after hours. Is that a reasonable expectation?
It certainly looks like it. Here's the historical free cash flow per share and earnings per share for ServiceNow. 30% CAGR on that free cash flow per share growth. So 18% over the next 5 years seems reasonable.
And it's natural to see a deceleration in the per share growth rate for free cash flow. ServiceNow, obviously much bigger business than it has been over the last 10 years. At 18%, that should put it on track to possibly be able to outperform VGT. This is one we're still happy to own. And whenever there are future dips in the stock price, which is inevitable given the high valuation multiples on this, it would be one that we would consider adding to on those dips.